Respected chairman of the session moderator of the session has given me 15 to 20 minutes time. I start count that 15 or 20 minutes right from now and go ahead on a subject, on a topic. You can see it on the screen that apart from the concept of income tax, which presently today, which is prevailing in our country, the world is moving and India is paving on the same step on the direct tax too, wherein we are going to follow, rather we are following the international best practice in the taxation, direct taxation. Look forward, the lot of changes that have taken place over last couple of years. We have adopted the global accounting practice called as Ind AS. We have adopted the best corporate law practice called as SEBI regulations and notifications, LODR, etc. We have adopted, this country has adopted the best practice of the indirect taxes called as GST, Goods and Service Tax. And then going ahead to the global best practices on the direct tax, this is what is particularly we are marching ahead. And last 2 years, if you have noticed, the majority of the changes in the direct tax frontier is not going into Section 80D, LIC deduction or insurance claim deduction or something that like. The changes are coming on a macro concept. And what is that macro concept is our discussion today, that we are moving, once again, we are moving to a global taxation platform situation. Like, let me take you one example which probably all of you remember, but once again to repeat it. We heard the story, all of you, not heard, we know the story of Vodafone and the tax incidents that took place in our country a couple of years back. Why I'm taking only Vodafone? Because this is the most debated one. There are n number of such situations going on. A few examples I will give afterwards, but let's come back to the main discussion point. A company which was prevailing in our country and operating in our country, that means the underlying asset of the company was in our country, called as Hutchison Telecommunications Limited, Hutch in short. So people of us across the country used to get the telecom operator services called as Hutch services, wherein 73% or odd of the ownership belongs to Hutchison of Hong Kong, and the 27% odd was with Indian corporate, right? Yes, sir. And then, in short, big stories cut short, this company was offered to sell, but the shares were not listed in the registered stock exchanges. The shares were transferred to one of the holding company of Hutchison at a country called as BVI, British Virgin Island. And Vodafone also opened up a wholly owned subsidiary in that particular country. And then the transaction took place between that two companies wherein the underlying asset of the Indian operating company got transferred. This much of the story is known to everyone. Balance part of the story is something that that the government tried to get that tax amount, 60,000 crores in the year 2006-07. Today by inflation, it could have been around 1,50,000 crores. 60,000 crores of that particular day was escaped because the contention was the transfer took place in a country where Indian tax law is not applicable. Very fair. 12,000 crores in one transaction got lost. It was a loss to the nation. It was a loss to the country. And any time, any economic forum, we speak about tax to GDP ratio, we speak about the contribution of tax to the country's exchequer, we speak about the GST collection is coming down, we speak about the tax rate of the corporate has been reduced by the Honorable Minister and the ministry concerned to accelerate economic growth. We at the same time cannot accept any such situation where the India's hard-earned money, the business which is operated in India, tax would have been receivable in India, is just siphoning out from our country to the other country because of such lapses, loopholes in the tax regulations. Now, that's the background of my study, my discussion, and then obviously I will land up with that where we can, with the professionals of CMS, can contribute into it in the new taxation regime. The government has come out with a wonderful concept. This is called OECD guidance, OECD guidelines. Majority of the guidelines issued by the Organization for Economic Cooperation and Development, OECD, which is actually followed by the pan-world every country for their taxation purposes. Like for, customs procedure, it is a globally accepted practice. Like for GST or the indirect taxes, it's a globally accepted policies, etc. OECD is coming out of these articles, and the majority of the articles are either implemented or going to be implemented in a very short span of time. Start with this first concept, what's called as BEPS, the Base Erosion Profit Shifting Models. I repeat it once again. It's happened every time, everywhere. Companies in our country, this is not a session on the cross-border taxation or international taxation seminar, but to give an idea, majority of the aircraft operator in our country are hiring the aircraft from some international agencies. Maybe Boeing or Airbus is the manufacturer, but it is taken on lease from a company which is registered in Ireland. Now, please remember the word Ireland, not any other country. There are double tax avoidance agreements between all the countries and majority of the big countries and Government of India, bipartite double tax avoidance agreement, in which the source taxation or destination taxation is very clearly mentioned. What is source taxation? That means if an income is arisen or accruing in India, it should be taxable at the origin point, called as source-based taxation. And there is a possibility that the income will never be taxed. It will be taxed only on the other country, that is a receiving country, called as destination-based taxation. We being the tax, not administrator, tax follower of the tax law or DTAA law, we only get a TRC, tax residency certificate of that particular person, and based on the TRC, we never attach any taxes, leave the entire amount flow to the other country. Mauritius is the best example for any of the financial transaction. Latvia, British Virgin Island, there are a number of countries which called as tax haven. And these tax haven countries provide on a receiving model of the double tax avoidance agreements. Question comes out, if my profit base is eroded, the income, the profit, the capital gains on Vodafone shares being transferred from Hutchison to Vodafone, if that base is transferred from India to Latvia or India to British Virgin Island, India to some other Cayman Island, then the government of this country, where the actual transaction is impacted, where the underlying asset is getting transferred, never going to get a single paisa revenue. And that concept is called as BEPS, B-E-P-S. The base, that means the base of the taxation, if that is eroded, I should protect it. And the entire direct tax today is marching ahead on this particular concept. And this concept, once again, this concept, at what value I am transferring the goods or services? At what value is actually recorded in my books and in my related parties' books in that other country, called as related party transaction. My friend, my professional friends, all of you are very aware, a number of these accounting standards were earlier also there, called as related party transaction. But once again, after Ind AS introduction from 2016, the related party transactions becomes a very, very, very important, because this is not only reflected in my books of accounts. If I am a registered, if I am a listed company, my RTP, related party transaction, has to be reported to the stock exchange concern on a regular basis with a justification to specify that the transactions are at an arm's length price. So if you look at everything at a platform, today accounting, standards, direct tax, BEPS, transfer pricing, arm's length price, related party transactions are coming into one single basket. And this basket becomes the driving force for the direct tax, direct tax to march ahead. And the OECD models the Government of India has already adopted has been given in the official publications on the websites for comment from the common people. are actually providing these different articles on which they are inviting comments from us. Us means the professional institutes, including individuals. The place of effective management, that means where the effective management of a company is situated. If it is by any chance, if it is in India, where the business decisions are taking place, it would be taxable in India. The country by country reporting, it is a wonderful approach, has already been taken. Why I am speaking these 4 points, very, very small points, but it has got a tremendous impact on the direct tax management from say 2020 onwards. The new tax regime is going to be launched, maybe in the name of direct tax code, may not be in the name of direct tax code, but a thorough amendment of the direct tax procedures in our country. Correct? In that, what we have already spoken, that we are marching, we are converging into an international tax practice situation, where the entire fundamental concept would be at what price I am transacting a product between myself to my related and unrelated party transactions. The transfer pricing modules are getting changed. Today, more number of senior officials are getting transferred in the department to the TP as well as international taxation, because they found out the lapses, if it is in the domestic frontier, if somebody evaded some 80 IA benefit, maybe 1, 2, 5, 10 crores. If somebody evaded a single logic in the transfer pricing determination, it may lead to around 1,000 crores revenue losses. And when the country is really striving to get more amount of tax to revenue, tax to GDP, that approach is definitely welcome. And that's probably the background where, once again, that accountant to cost accountant definition should be erased out, definitely is definitely required, but we should also demand, what we can also demand, that it is our prerogative right, I should say, it is our prerogative right of the members of the institute to claim that the entire transfer pricing, what is being made, what is being calculated, what is being taught, and what is being practiced in the department is absolutely a brainchild from this institute. Let me come out one or two. Let me just come out in one or two. And then I'll go back, if time permits, on the OECD global tax models. Again, the role of the accountant into it. If I just go ahead and to find it out, what are the policies that are normally being followed? What are the policies that are normal? These are the OECD models already being followed. Time permits, I will get back. I will come back because time is really precious today. Have a look. I believe a lot of you are aware, rather all of you are aware about the different policies or different methods that are actually adopted for determining transfer pricing. Very, very interestingly, the accounting standards, whether in India or across the world, never prescribes that what are the methods to be followed or which method to be followed. But the Indian law, tax law, following the OECD model, already has given these few models, few of the methods which need to be followed for determining our related party transactions in and around for the purposes of revenue collection, for the purposes of revenue determination, and to ensure that the revenue is not escaped. Very much it is possible, it is very much possible that I take a help of the double tax treaty, I take a help of some of the tax treaty arrangement, I take a help of the related party transaction wherein I try to reduce income in this country, maximize book the income in the other country. It is very much possible. It is possible in the way, say in the domestic frontier, in a domestic frontier also, if I know that my business is going to enjoy some tax holiday, if I set up my plant in Dadra, Nagar Haveli, Silvassa or Uttaranchal or Himachal or some other places, I may always float a subsidiary and then the subsidiary will enjoy a tax holiday. I may try to change my accounting practice wherein I will book most of my cost into my tax entity, tax bearing entity in say Maharashtra, Gujarat or other places, and most of the revenue in my tax holiday entity, which is maybe in Silvassa or other places. So as a whole, collectively as an entity, I will enjoy a tax benefit. My PBT, profit before tax to profit after tax, will enjoy the net benefit to my personal exchequer, not to the government exchequer. So these methods, if you can look into it, comparable uncontrolled price, what should be the price determination? What is the resale price? My friends, today, the department is, is more concerned about how to determine the price between two related party entities and want a certificate, want a clarification, want a declaration. SEBI is asking a declaration on every quarterly basis that whatever transactions you are doing with your related parties, please come out and give a declaration of it, that all the transaction at ALP, arm's length price. We speak about cost plus method, and we speak about profit split method. If you read any of this method, or whenever any of the methods are not applicable, say I am paying certain amount for a royalty for a particular medicine formula for a particular medicine that I have imported from my related party in Sweden, and I'm paying the money, whether it attracts arm's length, whether I'm transferring more amount of currency to the other country, whether for a medicine for a formula which should be actually paid for $100, am I paying $100 million from Indian exchequer? And in all these cases, I, as a global entity or entity having multinational presence, I may be personally benefited because I will take the advantage in Sweden, transfer the money to some other country and enjoy a tax holiday. But the poor people of the country and the poor government of the country will lose the tax revenue, and poor people of the country will pay a higher amount of prices for that particular product. Direct tax is moving into that frontier. And look this 1, 2, 3, 4, the last one says, if you're not able to find it out any of the method, look for the last method. And the last method once again says, any other which is suitable. So to determine the price of a goods or a services, once again it needs an allocation, appropriation, determination, crystallization of the cost. And if I now combine whatever I have discussed, the practice is going to come, already has come, because the OECD few models already we have adopted. Just let me show you few examples. Yes, another 4 minutes I have given, so another 4 minutes I will complete. These accounting standards, not the Ind AS, this is our own accounting standards, cost accounting standards. Believe me, whenever in certain forum of the Direct Tax Academy or the Regional Direct Tax Academy Institute, Training Institute, wherein I used to take some certain sessions, they are very, very meticulous to understand how these accounting standards could be actually used to determine the cost of a particular product or a service towards determination of the prices. And if you look any one of them, including the last few, that treatment of revenue in the cost statement. So what the element goes, which is whether it has got a global unadjusted price mechanism or not, to be certified by us. Us means the member of this institute. If this is being followed consistently, if these standards are adopted, if these standards following the global practices of the international accounting standards as well as the OECD models, my friend, the opportunities definitely lies that if by all the influence, all the request, all the persuasion, the moment we becomes accountant, because this homework need also to be done before we get something, the moment it comes out, we should also be able to ready to say that what being practiced is being practiced based on our accounting standard, our own, which is not somebody else. And that probably lies with the advantages, the benefits, and opportunities. Enter direct tax, maybe tomorrow, today all the corporates, I just take another 1 minute time left with me. Corporates tax rate has been reduced, everybody knows, 22% with a condition that you have to forgive all the advantages, all the deductions, exemptions. Very good. Why not that same flat taxation for an individuals also? You reduce the tax rate, increase the slab, and reduce that number, n number of deductions available in Section 80s to make government entities as well as the individuals more and more confused. So the situations are dropping into that, and the volume of tax collection from individuals vis-a-vis the volume of tax collection from corporates vis-a-vis the volume of tax collection from the multinationals is like now 10, 40, and then the balance from the MNCs. So government is emphasizing more on the MNCs, transfer pricing is the call of the day, arm's length price is the call of the day, cost accounting standards, redo the accounting standards are the backbone and the platform on which the entire calculation is made today. We need only a recognition for that, that you are doing it, please recognize us as an accountant, and then only we'll have the entire opportunities and future for in the profession. Friends, I just able to share my views that what we are today, what the government is doing today, what the global practice is, and if everything goes smooth, if the morning session really shows the morning of the day, by the end of the day, today, tomorrow, day after, we are very, very hopeful to get the definitions with us. And once it is, then, enter sky would be, even sky would not be the limit for all of us.